and we are definitely seeing a bit of a relief in the markets today. But when you think about positioning, you can break it down into two parts, right? What's the beta view and what's the alpha view? And I think both of these are important to consider this year. From a beta perspective, we've been generally cautious since the last week of January or the third week of January. That stance still remains for us. We aren't yet at a level where I'll be aggressively buying, but obviously we are getting close to that level. I would say that another 5 to 6% correction on the MSCI Asia ex Japan index overall would bring us to levels where we would be very comfortable buying for beta risk. In terms of allocation on the alpha side, I would say that our preference for value has been quite strong since January. We've upgraded value to a core overweight or like a founding principle of our portfolio at this point, having held growth as that core anchor over the last 2 years. So how we're seeing this right now is that most of the queries we're getting from clients in the last month or so has been around how to hedge for this value reversal or the value rally that we have seen over the last month. But I think investors really need to think more, in terms of core allocations and think that of all their portfolio, they need to allocate a certain position purely to value. And even in the other parts of the portfolio, like growth and quality, they do need to be a lot more valuation conscious and conservative in terms of how much risk they take, even in the growth and quality parts. So that's how we're positioning our portfolio for the rest of this year. We do think that value will continue to do well over the course of the year. We will obviously see this in periods of very strong value performance, as we have seen since mid-February, and then followed by some consolidations. So we could be getting to some sort of consolidation now, given that our crowding measures are telling us that the unwinding between growth and between value and momentum has kind of closed at this point. Banks are one sector that we like very much. So when you think about the value trade, right, we look at it in four different parts. There's a macro value trade, which is essentially rate sensitive. So here I'll put banks and insurance. And this is a trade that I think we will hold for the rest of this year. It's going to continue to pay us. Banks' relative performance versus index in Asia ex Japan is just back to about July levels last year. In the US, we're already back to March and February levels of last year. So there's still a lot of room for Asian banks to catch up from that perspective. The second part of the value trade is commodities and infrastructure and the stimulus related part of value that I think has already rallied quite a bit. So I'll be a little bit more cautious around that. The third part is the consumer and reopening related value. And the performance dispersion in that space is quite large. So I'll be focusing more on the laggards. And just generally, I would look at laggards overall as the anti-momentum trade. And I think all four parts of the value trade will continue to provide upside over the course of the year at different points.